Welcome to Talk Tickers, your essential deep dive into the most significant earnings calls. Today, we're pulling back the curtain on a bit of a corporate drama unfolding at Hain Celestial.
Yeah, Hain Celestial. You know, the company often associated with natural and organic products.
Exactly. And their Q4 fiscal year 2025 earnings call. Well, it wasn't just a report. It felt more like maybe a candid confession of past missteps.
And a radical blueprint for a pretty high-stakes turnaround, I'd say.
For sure. And the market's reaction, as you might guess, was swift and quite severe.
Indeed. We're looking at a company really at a pivotal juncture here. Hain Celestial hasn't just reported a quarter well below expectation.
Which they certainly did.
Right. But they've also announced this stark shift in strategy, really aiming to reverse years of underperformance.
So today we'll unpack the raw numbers, we'll analyze these radical restructuring plans.
And really consider what this all means for the company's path forward. It looks like a tough one. And crucially, what it might mean for you listening.
Okay, let's get straight to the headlines then, because the Q4 FY25 performance, it really did come in well below expectations, pretty much across the board.
Yeah, it was a challenging quarter, no doubt, marked by that substantial non-cash goodwill and intangibles impairment.
Right. The GAAP earnings per share, or EPS, it plunged to a deeply negative $3.06.
Minus 306.
Yes.
Compared to estimates of, negative 5 cents?
Exactly. A huge miss, mostly because of that impairment charge.
And it wasn't just the GAAP numbers either. Their adjusted EPS, non-GAAP measure.
That also missed. Came in at negative 2 cents against estimates for positive 4 cents.
So negative territory even on an adjusted basis. And revenue.
Revenue hit $363.3 million. That missed estimates by about $8.3 million.
And importantly, that's a significant 13% year-over-year decline. 13%.
Yeah. These numbers, they really paint a clear picture, don't they? Significant operational headwinds.
Absolutely. And it goes deeper.
Like the organic net sales.
Down 11% year-over-year.
And adjusted gross margin.
Decreased by 290 basis points year-over-year, down to 20.5%.
Wow. And maybe the most striking one, adjusted EBITDA.
Halved. Just halved. Down to only $20 million from $40 million a year before.
Yeah, these figures really speak volumes about the urgency for change. You can feel it coming off the page almost.
Management is definitely grappling with it now.
Okay, so let's unpack the core of these financial struggles. That headline, GAAP EPS miss, the huge negative $3.06.
Mostly driven by that massive non-cash goodwill and intangibles impairment charge, right?
Exactly. Around $252 million just in Q4, which led to a GAAP net loss of $273 million.
$273 million loss.
For anyone following the CPG space, this kind of impairment is, well, it's a painful public reassessment of asset values.
It truly is. And this isn't just some, accounting entry. It feels like a kitchen sink quarter.
Yeah, throwing everything in.
For a company like Hain, an impairment of this scale,
yeah,
it's not just about recalculating asset values. It's a very public admission that their long-term growth story, the one built heavily on past acquisitions.
Yeah. It just wasn't materializing as planned.
Exactly. It signals a hard reset. Which is often, the painful first step in a genuine turnaround story.
Okay, so beyond this impairment, what does the balance sheet tell us? I mean, about their ability to actually execute this turnaround?
Well, the company shows total debt around $705 million.
$705 million, okay.
And Q4 free cash flow was negative, minus $9 million.
Negative free cash flow, high debt.
And their leverage ratio increased too, up to 4.7 times based on their bank-defined EBITDA. That's getting up there.
That is a lot of pressure, especially when you're trying to restructure.
Absolutely. High debt, negative free cash flow. Those are immediate concerns.
Yeah.
Management recognized this, though.
They amended their credit agreement, right?
Yeah, to give themselves more flexibility. They increased the maximum net secured leverage ratio allowed to 5.5 times for Q4 FY25 and going forward.
So some breathing room, but...
But their long-term goal is still to reduce this significantly, down to 3 times adjusted EBITDA or less. It just highlights the scale of the deleveraging challenge ahead.
Okay, now here's where it gets, I think, really interesting. Because the CEO, she didn't hold back.
Interim President and CEO Alison Lewis.
Yeah. She acknowledged the disappointing Q4 performance, and she didn't really mince words about previous leadership.
What did she say exactly?
She criticized a focus on, quote, building structure, strategy, and process without enough actual execution.
The classic strategy-heavy, execution-light problem.
Exactly. which she said led to an inflated cost structure and slow decision-making. That's a pretty stark admission from the top, isn't it?
It's a crucial admission, and honestly one that often signals a genuine commitment to change. Management is essentially saying the old way wasn't working.
So the new way?
The new approach is described as a no-regrets move. They're shifting to a leaner, regional operating model.
Consolidating innovation too, right? Into just 2 hubs.
North America and international. That's it. The aim is all about prioritizing speed, simplicity, and impact, which is, vital for a CPG company today.
That kind of candid assessment from the CEO, it feels significant.
It really is. It signals that shift away from just strategy decks to hopefully operational rigor. The market often undervalues that kind of transparency, initially at least.
So how tangible are these changes going to be?
Well, one direct outcome is an incremental 12% cost reduction in people-related SG&A expenses.
12% cut in SG&A overhead.
Okay, and maybe even bolder. Alison Lewis herself is now directly managing the North American region.
She eliminated the President of North America role.
Yep, to, in her words, ensure greater accountability and faster execution.
Wow. The CEO stepping directly into a huge operational role like that. What does that signal to you?
It just underscores the urgency. It's a hands-on approach, a clear message that leadership isn't just dictating from afar. They're like getting into the trenches.
Trying to cut through the red tape.
It's exactly. Reduce duplication, speed up decisions, align execution closer to the actual consumers and customers. Most of these changes kick in between October and November.
And the full benefits expected by the end of fiscal 26.
That's the plan. It's a pretty comprehensive overhaul they're undertaking.
And beyond the organizational structure, they're also streamlining the product portfolio aggressively.
Yeah, significant SKU rationalization.
The example that stood out to me was Celestial Seasonings tea, reducing the lineup from over 90 blends.
Down to less than 55 over the next 2 years.
Cutting nearly half the blends for a brand kind of built on variety. That feels genuinely radical.
It signals an absolute commitment to focus. Cutting SKUs like that is about drastically reducing complexity, focusing resources on what actually sells, what's profitable.
And they're exiting some businesses entirely.
Right. Unprofitable or structurally disadvantaged ones, like the meat-free category in North America.
Discontinuing the ES product line.
And closing its manufacturing facility. The personal care business is also being exited.
These are tough calls.
Necessary ones, likely. The aim is to simplify, improve margins, free up capital, and, importantly, management attention for brands with higher potential. Companies that successfully turn around often start with this kind of aggressive portfolio cleanup.
And this whole reevaluation, it goes even deeper, doesn't it? There's an ongoing strategic review.
With Goldman Sachs, yeah. Aiming to maximize shareholder value by looking at potentially more exits or sales of businesses.
No definitive news yet, but
it signals a really broad, deep look at Hain's entire portfolio. This isn't just tinkering around the edges.
No, it sounds like a full overhaul.
Absolutely. It shows a willingness to shed maybe even legacy assets if they don't fit this new, leaner vision.
Okay, but with all these cuts, they still need to grow, right? And management admits they have not innovated with the speed or at the level necessary previously.
A common refrain, unfortunately.
But now they claim to have one of the strongest innovation pipelines in recent history lined up for fiscal 26. That sounds promising, but...
But after years of admitting under-innovation, what makes this time different? That's the key question.
And what are the hurdles to actually executing on that pipeline?
Well, they did give specific examples. Renovating garden veggie snacks, better salt profiles, avocado oil, introducing Hartley's juicy jelly pouches in the UK.
The Celestial Seasonings Anytime Wellness Tea platform.
And expanding Greek Gods yogurt into single-serve formats. So it shows a commitment to reinvigorating core brands, not just cutting things.
Execution is everything, though.
It is. Consistent market-relevant delivery will be the challenge.
And then there's pricing. They acknowledge that limited pricing actions in the last few years did not keep pace with inflation.
Yeah, a fundamental CPG challenge lately. Underpricing relative to inflation just kills margins.
So now they're implementing strategic pricing across almost the entire portfolio.
With some successful actions already taken in international and in North America for tea, baby, kids, and meal prep.
What impact could this have on their recovery?
Well, it's critical for margin recovery, assuming, of course, that consumer elasticity doesn't bite too hard.
Right, you raise prices too much.
You risk losing volume. But they also expect to reduce ineffective trade spend by over 50 basis points as a percentage of sales.
Optimizing promotions.
Exactly. That should also support profitability. These seem like smart, disciplined moves for the bottom line.
Okay, beyond pricing, where else are they finding efficiencies?
Well, they delivered $67 million in productivity in fiscal 25. That's about 5.5% of COGS.
That's pretty good.
And they expect over $60 million in gross savings for fiscal 26. They're also reshaping the North America distribution center network for, greater efficiency.
And working capital is another focus area.
Yes. Days payable outstanding, DPO, has already improved quite a bit, from 37 days in FY23 up to 65 days in Q4 FY25.
So they're taking longer to pay their suppliers.
Right. The long-term goal is 70-plus days by FY27. However, D's inventory outstanding, DIO.
How long stuff sits on the shelves?
Exactly. That remains an area for improvement in FY26.
Yeah.
So work to do managing stock levels more efficiently.
And digitally, what's happening there?
They're accelerating e-commerce investment, aiming to grow at or above category rates in fiscal 26.
Shifting marketing spend, too.
To digital and social-first marketing. They say they're seeing improved ROI and reach from that.
Any specific examples?
Yeah, 10% e-commerce growth in North America and improved online share for their soup brands in the UK.
These initiatives, they sound pretty foundational for any modern CPG company, really.
Indeed. Efficient operations, good cash management, strong digital presence. These are table stakes now. Non-negotiable for competitiveness.
It feels like a comprehensive effort, connecting the dots, not just fixing the books, but transforming how they operate and connect with customers.
That seems to be the goal, bringing the company into the modern era.
Okay, let's look at where these declines were felt most acutely then. The downturn was pretty widespread across the segments.
Yeah, North America organic net sales down 14% year over year, mostly driven by weakness in snacks and meal prep.
And international.
Organic net sales there were down 6% year over year, impacted by meal prep and beverages. They cited category-wide softness in wet baby food.
And even unusually warm weather affecting soup sales.
Right, a few external factors there.
Looking specifically at snacks, though, organic net sales plunged 19% year over year.
19%. Ouch. Due to, quote, velocity challenges and distribution losses.
They noted some very preliminary green shoots from new products and marketing, but
snacks is an impulse category. It requires, as they put it, continuous news, continuous innovation, marketing buzz.
which raises the question, can they actually sustain that continuous news cycle against really well-established competitors? The snacks market is notoriously tough.
Very tough. Execution, again, will be key.
How about baby and kids?
Organic net sales down 9% there, mostly due to softness in purees and those CZ reductions we talked about.
But there was some strength.
Yes. In Earth's best snacks and cereal. That's a positive sign within the segment.
And beverages.
Saw a 3% organic net sales decline. But their non-dairy brand Joya actually gained share.
And Celestial Seasonings bagged tea gained distribution.
Right. So these nuances are important. Even amidst the struggles, some specific brands or categories showed resilience, even growth.
Indicating where they might still have some inherent brand equity to leverage.
Exactly. Some foundational strengths to work with, hopefully.
Okay, so the market reaction, we touched on it, but it was severe.
Extremely severe. The stock dropped about 30.2% from the prior, close to the same day close.
Fell from $2.15 down to $1.50 in a day.
Intraday drawdowns were over 25%. This absolutely smashed the historical implied moves around their earnings, which were typically more like plus or minus 10%.
Shows just how badly investors took this news.
Investor sentiment is, let's say, decidedly cautious right now. Execution risks, demand headwinds. They're clearly overshadowing this restructuring narrative for now.
And the lack of quantitative FY26 guidance probably didn't help.
Definitely heightened uncertainty. Traders just focus heavily on the sheer magnitude of the miss, the impairment, driving that sharp sell-off.
Even though management was trying to push this long-term simplification method.
Right. And remember, this comes after an already terrible period for the stock. It was down nearly 80% over the last year, even before this. Prior quarters also missed estimates. They had FY25 guidance resets. It's been rough.
So let's talk about that guidance, or the lack of it. Hain Celestial is not providing quantitative FY26 guidance. Why, again?
Due to the uncertainty surrounding the outcome and timing of that big strategic review with Goldman Sachs.
Okay. Understandable, maybe, but unsettling for investors.
For sure. But it's perhaps realistic. given the scale of the changes happening and potential divestitures.
Mm-hmm.
Qualitatively, though, they did offer something.
What did they say qualitatively?
They expect stronger top and bottom line performance in the second half of fiscal 26 compared to the first half.
Driven by the cost cutting and executing on those 5 key actions they outlined?
Right. They're basically signaling, look, the pain isn't over yet. The first half of 26 will still be tough.
But there's maybe a light at the end of the tunnel, albeit a distant one.
Exactly. For Q1 FY26 specifically, they expect net sales and adjusted EBITDA to be pretty similar to the disappointing Q4 FY25 levels.
So no immediate V-shaped recovery here.
Definitely not.
Yeah.
They do project positive free cash flow for the full year FY26, though.
Even though Q1 FCF is expected to be an outflow due to seasonality?
Right. And that long-term goal, reducing balance sheet leverage down to 3 times adjusted EBITDA or less, that remains a key objective.
So the overall aim is clear. Transform this kind of diffuse, natural, organic portfolio
into a much tighter, regionally led engine, fewer SKUs, clearer brand economics. It's a massive undertaking.
And success hinges entirely on execution.
100%.
So what does this all mean for you, the listener, the investor, looking at Hain Celestial? It's clear they're in an all-out turnaround effort.
Making these no-regrets moves, openly acknowledging past failures.
But the immediate market response? Deep skepticism. Focus on the present challenges, not the future promises.
The story of Hain Celestial is far from over. Will this be a case study in corporate redemption? Or, a cautionary tale of a natural foods pioneer that just couldn't adapt?
Indeed. And while the broader market's been strong, the staple sector, where Hain lives, has generally lagged tech.
And Hain's underperformance is new, but these Q4 results just magnify the urgency.
So key catalysts to watch for.
Definitely interim updates on that strategic review, any asset sales, evidence of sustained velocity gains, especially in snacks and baby, a clear inflection point in margins and EBITDA.
And tangible balance sheet actions like actual debt reduction.
Absolutely. The success, again, it hinges entirely on execution. Can the new model, the cuts, the innovation deliver quickly enough, especially with that balance sheet under strain?
That really is the billion-dollar question, isn't it?
It is.
Okay, let's pivot to our This Is Not Financial Advice segment, where we pitch, shall we say, outrageous but plausible trade ideas, right? Like a hedge fund analyst maybe having a bit too much coffee.
All right, well, the market absolutely hammered Hain Celestial. Q4 was a disaster, numbers-wise.
Yeah.
But for those with a very high-risk appetite, this level of distress, this radical reset, it does create an interesting volatility play.
The company is now in full turnaround or die mode, essentially.
Pretty much. The lack of guidance, the aggressive cuts, potential divestitures, it creates massive unknowns. And the stock's trading around, what, $1.50 after that brutal sell-off.
So our trade idea today is the phoenix from the ashes long strangle.
Okay, explain that. It's basically when you don't know if a stock is going to soar or plummet.
Exactly. But you're convinced it's going to make a huge move one way or the other. This strategy bets on that extreme volatility itself.
Okay, so what's the action?
The action here would be to buy an out-of-the-money call option. Let's say maybe a $2.50 strike, 6-9 months out, and
at the same time,
you buy an out-of-the-money put option, maybe a $1.50 strike, same expiry date.
Got it. Calls for the upside, puts for the downside. Betting on a big move.
The rationale is this isn't about trying to perfectly time the bottom. It's about playing the magnitude of potential future news.
Right. If they actually start showing tangible results, the regional model works, SKU cuts boost margins, innovation hits.
Then the upside from a $1.50 could be significant. The call option pays off.
Conversely, if execution falters, if the strategic review uncovers more skeletons, maybe a fire sale of assets.
Then the downside could extend further, maybe even towards delisting territory. Who knows? The put option pays off.
So the long strangle captures both extremes. You're betting on a large move, either direction, because the uncertainty and the stakes are just so high right now.
It is highly speculative, let's be very clear, but for those betting on an all-or-nothing transformation, the current setup definitely points to significant potential movement.
Okay, and that wraps up our deep dive into Hain Celestial's Q4 FY25 earnings.
It's clear the company is at a really critical juncture, embarking on this comprehensive, high-stakes turnaround.
Yeah, the coming quarters are going to be absolutely crucial, demonstrating whether these no-regrets moves can actually translate into tangible financial improvements.
We'll definitely be watching closely for updates on that strategic review and their operational execution.
It's a story of a legacy brand really fighting for its future. The next few chapters are going to be fascinating to follow, one way or another.
Absolutely. Remember, everyone, the information shared here is purely for educational purposes. It should not be considered financial advice.
Please always do your own research.
Thank you for joining us on Talk Tickers, and we look forward to our next deep dive with you.